This video examines the tool of economic policy within the United States and goes over some of the indicators and statistics that we use to be able to understand how the economy grows and how to stimulate the economy. So if we take a look at the goals of economic policy in the United States, we have five main goals for economic policy. Most of this is calculated by the federal government. So we've got economic growth, like gross domestic product. One of the goals is to have low unemployment. We'd like to have full employment, which is somewhere in the neighborhood of about 5%. Some economists now say about 4%. You don't want to have a labor market that's too tight, or we will get the second problem here, which is low levels of inflation. Oftentimes, as the employment market job market gets really tight because people have jobs. We have to pay more wages in order to be able to attract new people to your jobs, and that causes inflation to rise. So we want to keep inflation at around 2%. That's the Federal Reserve's charge. Talk a little bit more about that. We want to have a positive balance of trade with other nations, although this, again, among kind of economists and political economists, is somewhat of a point of contention as to how important that is. And then finally, managing the national debt, which is another lecture in the series, is another goal. So let's take a look at each one of these. First, as you can see here, economic growth is very important for government. And the way that we define economic growth is by taking a look at the overall United States economy. And got a really kind of longitudinal chart here that has a little bit of overlap on it. But I wanted you to see the long term over the last 15 or so years, including the Great Recession, to help understand a little bit about the way that we calculate when we're in a recession and when we're out of a recession. So if you take a look at the chart in the upper left-hand corner, you see that around late 2008, early 2009, we have 4 quarters there, meaning 3-month increments, in which we had negative economic growth. Particularly the first quarter of 2009, you see that the economy contracted by over 6%. And that certainly is very radical. Now, we define a recession as being 2 consecutive quarters of negative economic growth, which essentially means 2 quarters or 6 months in which the economy contracts. So if you take a look at the first quarter of 2008 there is 1 quarter in which the economy contracted, but that was not a full-on recession because it was only 3 months. If you take a look again at the first quarter of 2014, you'll see that the economy contracted for that 1 quarter. If I recall correctly, that was primarily because some very serious weather patterns and snowstorms, which kept people from purchasing products. Believe it or not, the weather can actually affect the economy, not just the coronavirus. So as we've gone through here, basically we've been in a very long period of economic growth in the United States, dating back to the end of the Great Recession, which ended a lot earlier than some of the severe economic pain for people. So oftentimes we'll come out of a recession. In other words, the economy starts to grow again, but it doesn't necessarily translate into jobs immediately. But as you see here, since 2009, with the exception of that 1 quarter in 2014, we've had positive economic growth. This is only through the end of 2019. We don't have the first quarter economic growth yet for 2020. We do know that the economy has contracted in March and does not look good going forward, at least for the next quarter. As to whether or not we'll get 2 quarters of negative economic growth leading to recession, we'll have to wait and see. Many economists are predicting that at this point in time. But again, we don't have that data yet. We'll find that a little bit in the future. But one thing I also wanted to highlight here was that while we talk in the United States about the gross domestic product of the entire country, It's also important to realize that, we are made up of a lot of different regions with different source of economic development and growth, and our economies are driven by different things in different states. So if you take a look at the country, we can have situations in which one state might be in a recession while other states are still having some serious economic growth. And a lot of this has to do, with the types of products that states offer, whether or not they're natural resource dependent, whether they're tourism dependent, whether or not they're agriculturally dependent, whether or not they're financially based, that sort of thing, has a profound impact. So, if you see here, this is the comparison. What we try to do is look quarter over quarter from each year. So the third quarter of 2019, essentially meaning the beginning of the second half of 2019, and then the fourth quarter being October, November, and December of 2019. And you see that overall the U.S. growth rate was 2.1%. And you have varying states here. So Pennsylvania, as usual, is pretty average for 2.1% economic growth. Then you have those states like Washington with 3.4%, Texas, Florida as well. And then you got states that are underachieving. So actually, if you take a look at West Virginia's economy, their state domestic product actually was negative during this time period. Wyoming also negative or even, and North Dakota is very slow growth. A lot of those are resource dependent, which becomes somewhat of a problem as prices fluctuate. Just wanted to also point out here that when we're talking about economic growth, most of the growth in recent years has been in the 2% range up to around 3%. That's not very high growth. But what we've seen is kind of these slow but steady economic gains in the U.S. In recent years. Some of them probably, depending on what economists you're talking to, political scientists that you talk to, the prolonged economic expansion is probably the consequence of the tax cuts from 2017 from Republicans and Donald Trump. Now, the importance of economic growth is essentially that it adds, from the government's perspective, is not only do we have a lot of people employed, as we'll see in a couple of minutes, but it also adds to government revenues as well. And in general, this allows for one of two things, and it's often party dependent. If you're a Democrat, oftentimes what happens when we get more money, more revenues coming in because of good economic growth, that's a reason to start supporting new social programs. Republicans tend to be more oriented towards using extra revenue as a reason to cut taxes. And this is particularly more so at the state level than at the national level. Another thing about economic growth is that it makes redistributed programs more palatable to people. If everybody's working, if the economy's humming along, we tend to be more unified as a country, as opposed to, if you remember back to Lowy's theory of the politics of each policy, redistributed politics are the most conflictual, but when we have economic growth, it's a little bit better. And then finally, I'm going to pause here for a second. What is the number one goal of members of Congress or politicians, according to Richard Fenno? Re-election, correct. But you didn't say it loud enough. Let's just stop. I want everybody to stand up and jump up and down and say, what's the number one goal of politicians from Richard Fenno? Re-election, all right? Economic growth is great for re-election. You can ask presidents like Bill Clinton, Ronald Reagan, and you can also ask presidents who lost, like George H.W. Bush and Jimmy Carter. Now, there are three types of unemployment that we have. I'm going to show you this short video, I think, which goes through these 3 points in a fairly accurate manner.
Unemployment occurs when a person who is actively searching for employment is unable to find work. The most frequently cited measure of unemployment is the unemployment rate. This is the number of unemployed persons divided by the number of people in the labor force. Unemployment is often used as a measure of the health of the economy. There are three types of unemployment frequently referenced in economics. 1. Structural unemployment. Changes occur in market economies such that demand increases for some job skills and decreases for others. For example, the invention of the automobile increased demand for automobile mechanics and decreased demand for horseshoe makers. 2. Frictional unemployment. This occurs when workers are voluntarily between jobs. This can take time as the individual searches for a better job, a new location, or other factors that can delay employment. 3. Cyclical unemployment. This occurs due to downturns in overall business activity. When business cycles are at their peak, cyclical unemployment will be low. If the business cycle is low, cyclical unemployment will rise. The natural rate of unemployment is that amount of unemployment that occurs naturally due to imperfect information and job shopping. It is the rate of unemployment that is expected when an economy is operating at full capacity. At this time in the U.S., the natural rate of unemployment is considered to be about 5%.
And again, we talked about that that peak employment oftentimes now is considered to be a little closer to 4%. Now, so one of the things that we've been talking about really is the cyclical unemployment rate depending on the economy. One of the big things that we're talking about in the United States long term, and one of the reasons why candidates like Donald Trump and Bernie Sanders probably have been doing well, is that structural unemployment. And there are certain places around the country that are hit harder than others, particularly manufacturing. And one of the reasons why people were pushing for guaranteed basic income is to deal with the structural unemployment that's going to come with automation. That's a story that we can talk about at another point. So here's an historical look at the unemployment rates in the United States between 1948, essentially a little bit after the end of World War II, going straight up through March of this year, 2020. And obviously you can see that at points in recessions are the points at which we get the highest unemployment. So the worst economy that we had in since World War II really was back in the 1980s with about 10.3 or 4% unemployment. We hit 10% in 2009. And then again, you see kind of the drop in unemployment as the economy gets better. We are, if you just take a look at the last several years, you see the big kind of wave that we see, or the bell curve that we see as a consequence of the Great Recession. Unemployment spiked very dramatically and is slowly been inching its way down as low as about 3.4%. And you can see this little tiny tick right there at the end in 2020, which is March, essentially almost a full percentage point growth of unemployment in 1 month as we start to see the effects of COVID-19 on the economy and people filing jobless claims. Probably the full effect of that won't be felt through April or potentially May. Some economists are talking about upwards of 15% unemployment at this point. But again, those are just predictions. One of the things that we can also take a look at is the types of unemployment that we have. And that video mentioned the idea of frictional unemployment. For a lot of people, it's not uncommon for them to be unemployed as they're switching jobs or looking for new jobs, or they're on contract work. And what you see here is indications of how long people have been unemployed. And the norm is, somewhere in the order of 3 months or so. And unemployment benefits in normal times last for 26 weeks. Oftentimes, during recessions, federal government will double that to 52 weeks of unemployment, but typically 26 weeks. But what you see here is a very interesting kind of pattern that when we get into these bad economic times, if you see the light green line there, 27 weeks and over, is when we start to see people that are chronically unemployed. In other words, they've been out of the job for more than 6 months, and that certainly is what starts to take the economic toll, because they don't have enough economic reserves built up to be able to handle that. If you take a look at the whole way to the right-hand side of the chart with March 20th, 2020, you see a huge spike in those people that are unemployed for less than 5 weeks. Obviously, this is the result of our self-isolation and basically the slowdown in the economy about all but essential work. And in the coming month or so, we'll see probably a much huger spike in that as well. There's a lot of demographic data that you can take a look at if you go to the Bureau of Labor Statistics, and I certainly enjoyed geeking out and getting this, but I tried to keep it somewhat limited because I know that people don't always like data quite as much as I do. But I wanted to show you one chart that's very predictive of unemployment and really kind of the divide in the United States. Race is also a big factor, but I pulled out educational attainment here. So this is unemployment rates for people 25 years or older by the educational attainment. And what you see is the light green line at the bottom is people that have a bachelor's degree or higher. And in general, what you see is that the economic pain isn't as inflicted on them quite as much during bad times. So even during the height of the Great Recession, people that had college degrees, the unemployment rate was only about 5%. As you compare that to somebody who has less than a high school degree, which was up above 15%. So education makes a really big difference in people's ability to be able to get jobs. Now, it doesn't necessarily mean that people are in jobs that pay a satisfactory wage. Doesn't mean that they didn't lose their job and took a pay cut. But people that do have college educations do fare better in the employment market. So just keep thinking about that as you complete your college courses for the semester and keep going. There's a second thing that I'd like to talk about here, and that's the way that we calculate underemployment rates. So we have people that don't have any job. And then we also have, from the Bureau of Labor Statistics, what they call the U6s, which are people that are underemployed. So the U3s are people that are unemployed but have been searching for jobs in the previous month. On the other hand, the underemployed people are people that might be employed part-time and haven't really, or people that haven't really been looking for work recently. So those are people that basically have some type of small jobs, but not enough really to help them out. And our underemployment rate then is much higher than our traditional unemployment rate. So as we're down to, under 4% at the end of 2019, the rate for people that are underemployed is almost double, almost around 8%. So that's one thing to keep in mind. Different countries define unemployment in different manners. We're heavily kind of criticized in the United States by some economists and scholars who argue that basically our unemployment rate doesn't take into account people that have just decided to stop looking for a job. So that the underemployment is really, a better indicator of the real unemployment rate than the employment rate. Now, high unemployment, number of problems with this. One, obviously, it's harmful for people without jobs because they have no livelihood and no way to be able to pay their bills. It also stresses government's budgets because of the fact that there's less tax revenue coming in because less people are working, so income taxes are not coming in. But also because at the same time, when revenues are falling, the dispersions of money are increasing. So we have needs for things like unemployment insurance. We have needs for food stamp programs. We have needs for welfare programs. We have needs for Medicaid, which is the health care program for the poor. So all of these things spike during recessions, and at the same time, government's forced really to do more with less, which usually leads to budget cuts or increased taxes. I just wanted to show you a quick overview of what happened in the Great Recession to deal with unemployment rates. So uh, we don't really know enough about what's going to happen with the most recent stimulus plan here. It was just passed by Congress and President Trump. But the American Recovery and Reinvestment Act was a stimulus program passed under President Obama in the early part of 2009. Basically pumped $787 billion into the economy. About a third of that went to individual tax cuts. Families got tax credits, which they could use to go out and spend. There was also a number of shovel-ready projects that were made in an effort to be able to get people back to work. And then finally, the last big thing was entitlements, whereby the federal government gave a lot of money to states for unemployment insurance, as well as Medicaid, which is a shared state program. And as a consequence of that, they really help the states out. Now, economists are somewhat unsure about what the overall benefits of all this are, but you can see that there are, low estimates, high estimates, take somewhere in between. It probably saved somewhere between about a half a point and a percentage point of unemployment to have done this. So, it did have a profound effect on a lot of Americans' lives, but it did come with a very big price tag, nothing like the $2 trillion that we just saw passed, but nonetheless, a very, very large stimulus bill. The lower levels of inflation, what we see is that the Federal Reserve has two primary goals. One is to increase employment. Second of all is to keep inflation at bay. And inflation is basically just the cost of goods going up. So we calculate that by the Consumer Price Index, which is just generally the government tracks a basket of goods which it considers to be essential to people's lives, and sees how much that changes month to month in the cost for that. And that gives us the indicator of what inflation is. So if you see in the bottom right-hand corner here, there oftentimes, because food and energy fluctuate so much, and you really see the price of energy fluctuates an enormous amount. If just understanding right now, the prices of gas have plummeted because of the lack of demand. You'll see that bumps around a lot. Oftentimes, they'll pull out food and energy as a measure of inflation because that creates a more stable index. But if you can see that real tiny line there, that little light blue line, what you'll see is that the Fed's been pretty good at keeping inflation at or around 2%, or we're at a little bit more than 2%. And also you see a couple points there. So for example, if you take a look at 2008 into 2009 there, we actually had a point during the Great Recession in which we had deflation. In other words, prices were going down. So the problem with inflation essentially is that costs go up because we're paying more for goods. And if people's wages aren't going up, that creates serious problems for families trying to buy things. And the consumer economy is so important in the United States. It also hurts people that are on a fixed income. So if you've got somebody who's retired and already has their entire savings, if the price of good goes up, that means that they can't buy quite as much, and that may hurt them economically. If you have debt, though, your wages are probably going to go up, and that means that the amount of debt that you have goes down in a regular in a relative manner. One of the other things that we should take a look at here is the positive balance of trade, and we usually tend to call that the trade deficit in the United States because we have a trade deficit. So our three biggest trading partners, and they pretty much dwarf every other country that comes below them. Our number one trading partner is Mexico, second is Canada, and third is China. Again, we've just gone through with the renegotiation of NAFTA. Our biggest trading partners, which we generally don't think of, are Canada and Mexico. And in general, we would like to export more than we import. But the U.S. has been, over recent decades, been a net importer, meaning that we buy more products than we receive. Just going to take us back over here. This is from census data. A little difficult to see here. But here are this is through the entire year of 2019. So you see that Mexico accounts for 14.8% of our trade, and Canada is exactly right there with them at 14.8% as well. And then China accounts for 13.5% of our trade. Now, in looking at this, you'll notice that there are some deficits here. So these are our exports to Mexico, Canada, and China, and these are our imports. And China is our biggest deficit of trade partner. So we imported $452 billion worth of products from China and only exported $106 billion to China. So if we go down here, we've got a couple of countries that we have trade surpluses with, but they're relatively minor. So thank you, Hong Kong, Netherlands, UAE, our good friends in Australia, and Belgium, of course. But the real trade deficits, on the other hand, really with China, with $345 billion trade deficit in 2019, and a pretty big trade deficit with Mexico at $101 billion. We don't see Canada being quite as high on this list, only about $27 billion. So we more or less, our trade with Canada is more or less balanced in the grand scheme of the total amount of trade that we have. So, there's been some discussion about this as to why it's important. If we're not as competitive, it poses risks for jobs. Manufacturing has been one of those industries that's been hit very hard by outsourcing to other countries. But the reality is right now that we're losing jobs, not so much to outsourcing to other countries, but to automation. Also, and I think we're finding this right now, is that if we outsource all of our manufacturing, some of the problems associated with that are that we lack kind of vital national security infrastructure to make our own products. And I think, in talking about ventilators and various other things that we're producing right now as a response to COVID-19, that will be something that we're going to start to think about again in the future. One of the other things is you take a look at a company like Boeing, and it's one of the two largest airline makers in the world. It's a strategic company that's very important for the United States to prop up because we need to have that infrastructure. So, it can be negative when we've outsourced everything and we can't manufacture products that we actually need here in the United States. And then finally, a lot of what President Trump has run on has been unfair trade policies, both in his renegotiation of NAFTA, as well as also slapping tariffs on China and negotiating with them as well. These are things that we constantly go through as balance of trade. And the final thing here is that we have to manage the national debt. We've seen that that's skyrocketing, going over $1 trillion a year. Part of the problem that's really bad for the economy with the national debt is that it drives up the cost of people that need to borrow money. So if the government's borrowing all this money, it means that there's less money available to consumers or to businesses to expand the economy. And that's a net negative. The cheaper it is to be able to borrow money, the better off, and generally the economy is. And then the other thing is, as we've taken a look at different points in time, we have some concern about other countries buying up our debt and then us being reliant on those countries. So there's a couple of tools that we use in the federal government and also state governments as well in dealing with economic policy. The number one thing is really kind of fiscal policy, and that's the budget process. how much do we spend and where. Some of the shifts during good and bad economic times. How much do we want to spend versus how much do we want to tax? When we find ourselves, the traditional model of kind of Keynesian economic policy is that during good economic times, we should raise taxes and put a little bit of money aside. And then during bad economic times, we want to increase our spending to encourage people to spend more money and to give people jobs. And we can run a deficit at that point in time. States don't, and states do not have that luxury because they cannot deficit spend. So the federal government oftentimes has to step in as the prime partner and spend deficits and pass that money along to the states. Second tool of economic policy is monetary policy, and this is the Federal Reserve. So one of the big things that the Federal Reserve does is to keep the economy going, one, by raising or lowering interest rates, and second of all, by providing what we call liquidity to the markets. In other words, allowing free money to flow so that people can borrow on a regular basis. If you take a look at the Federal Reserve, this is the interest rates that they charge for lending over the long term. And what you see is we've had historically low interest rates in the United States really over the last almost 2 decades. And certainly from the Great Recession up until the last year or two, rates have been very low at 2.5%, being the high in recent years. They've effectively cut the rates almost to zero right now to deal with the economic consequences of COVID-19. You see that huge, massive spike back in the early 1980s. We had a Fed chair, Paul Volcker, who basically wanted to put the brakes on inflation and pretty much crippled the economy with rates in the area of 18%. But what we saw was that led to a prolonged period of economic growth after that during the 1980s into the 1990s. As we go back up, we don't oftentimes think of regulation as being economic policy, but often, particularly Republicans, make the argument that regulation hurts economic growth. In periods of a bad economy, oftentimes regulations on businesses and environmental things are oftentimes relaxed a bit or not enforced quite as much in an effort to spur the economy. We also have incentives, subsidies, and supports. These are tools to encourage people to buy certain products. Talked a bit about tax expenditures. So one of the big things that was used during the American Recovery and Reinvestment Act during the Great Recession was the idea that we should invest in green energy and greening the country. So people got tax credits to go out and re-insulate their homes, get more windows that were more efficient, energy efficient. And the idea was to put people to work while at the same time accomplishing this goal of making our country more energy independent and also using less energy. Then finally, tax policy can be used as an economic tool to help deal with problems related to inequality in the country. So we can have what we call progressive versus regressive taxes. Progressive taxes basically just means that the more that you earn, the more that you pay in taxes. So we have that graduated income tax system in the United States at the federal level with various different rates that people pay depending on your income. That's progressive. Regressive taxes are generally taxes that either apply equally across the board to everybody or else in some way impact poor people in different ways. So we talk about the sales tax essentially is oftentimes considered to be a regressive tax because of the fact that in Pennsylvania, at least everybody pays 6% regardless of how much you earn. Other taxes that are sometimes considered to be regressive are those payroll taxes of Social Security and Medicare, where we all pay the same. So that's a quick overview of some of the tools of economic policy and how the government tries to work on enhancing the economy and the indicators that we use.